the relationship between global liquidity and asset prices is exceptional. It's like one of the strongest things that I've ever seen, but that doesn't mean that the R squared or that relationship, that explanatory factor of one on other doesn't wiggle and change over time because markets are totally non-stationary. But should it matter in the end? 100%, because every extra unit of liquidity or currency that goes in the market finds a home. It generally finds it a home in asset prices. And then you start looking at which asset prices are the most sensitive to the increases in liquidity. And of course, you've got tech, crypto, Bitcoin.
GM, good morning. Welcome to the Milk Road Show, the daily crypto show that has been counting down the days to Q4 like a kid waiting for Christmas. I'm your host, John Gillen, and today we are joined by the brilliant Jamie Coutts. Jamie is the chief crypto analyst at Real Vision, a financial media platform where he specializes in cryptocurrency, blockchain strategy, and delivers industry-leading insights on market trends, liquidity cycles, and digital asset investments. With over a decade in traditional finance, including launching Bloomberg Intelligence's first crypto research project, Jamie is one of the best analysts in the entire world at bringing institutional-grade frameworks to crypto. Today, we're going to discuss everything: Jamie's outlook on Bitcoin, his recent deep dive report on smart contract platforms, what investors need to know, and finally, I'm going to have him give us some alpha on Real Vision's most famous metric, global liquidity. So if that all sounds good to you, make sure you like and subscribe. Share this episode with someone who needs to hear the wisdom. And for our followers, our YouTube listeners, make sure you're liking, subscribing, commenting on YouTube. And if you are a podcast listener, a 5-star rating and review means the world to us. So it really helps us grow if you can give us that. And today's episode is brought to you by Nexo, the platform that grows your crypto without locking it away, as well as Figure Markets. Grow your cash like a bank, no lockups, just real returns. And without further ado, welcome to the Milk Road Show. Jamie, how are you, sir?
I'm really well, thanks. Thank you, John.
I am glad to have you here. I think before the show, we were talking about how you always seem to find your way onto the show during times of distress in the market to calm people down. So I'm really glad to have you back. And I thought that would be a good place to start today's conversation. Just what are your general thoughts on the market? Are you panicking? Are you scared? Are you running and saying the sky is falling? Or are you having a different, more calm perspective on where we are today?
Reasonably relaxed. I know the market is fixated on cycle tops and peaks. That's just a legacy of having so many of these massive bull markets and the long corrections, deep corrections that we've had in the past. And I guess the cookie cutter approach of looking at what's happened in the past and applying it to the present or the future. And I think that is causing anxiety because, generally, if it were to follow that formula, then really market should be peaking right now, or maybe we've even topped. The data and the analysis that we do at Real Vision doesn't suggest that at all. And there's always criticism that you're sort of moving the goalpost, but basically when you look at financial markets, there are financial relationships which are either strong or weak, and even the strong ones are non-stationary. But if you sort of approach it from a first principles basis of understanding what are the key drivers of markets, then if the factors that are supporting higher prices are still moving in the right direction, or importantly, are about to inflect in the right direction, then it's very difficult to be bearish.
Well, some people are still managing to pull that off. I think that would be really helpful to start out here. You talked about inflection and where we are in terms of like the market cycle tops. Let's start with Bitcoin and use that as a way into the crypto markets right now. A lot of people have been a little bit frustrated with the stagnation that we've seen in Bitcoin's price. It hasn't kept up with some analyst expectations. What, in your view, are some of the drivers of this stagnation in Bitcoin's price? What's been holding it back in this sideways period we've seen?
I think, firstly, if you just look at global liquidity, that's been expanding for really since 2023, but it has been moving at a slower pace than in the previous cycle. So if you have people who are investing or started to invest in crypto in the last cycle, or have even come in this cycle and they're just looking one cycle back, then what they would have seen on most of the global liquidity metrics that now everyone has been popularized by people like Raoul, obviously, and Michael Howell, who's been doing this work for many, many decades. What you're seeing is that, there is a more gradual ascent in terms of that liquidity factor in the market. And I think that's been somewhat of a, not a drag, but it just hasn't meant that, it's lived up to people's lofty expectations. Look, 2020 and 2021 was exception to the rule in the way that liquidity was really pumped in. Not to say that it can't happen again in some sort of future crisis, but like it was very extraordinary. So to apply that framework to today is in terms of like the degree or the velocity of the liquidity impulse, I think is probably catching a lot of people off guard or disappointing. But also the way in which, the way that last cycle was extraordinary has impacted the liquidity contraction that we've just gone through being longer than it has in the past. If you look at proxies like global liquidity, like global total liquidity, that is, so looking at the bank balance sheets, the monetary base, the central bank balance sheets, FX reserves, then that has been that's been moving higher now, but we've actually only just gotten above the global liquidity high point or high watermark from the previous cycle in April of this year. So for 3 years, global liquidity actually went sideways. You could say it sort of contracted. Now, at the same time, debt has continued to explode higher. The largest borrower in the world, the US government, is growing at sort of 10 to 11% a year. And liquidity has not matched that. So whilst I think that global liquidity has been slower up to this point as a sort of a response to the excessiveness of the last period, that's impacted the business cycle, which has not really moved into expansion. And now I think it is starting to, and then we're going to start to see those sort of the final piece of the cycle equation come into play, which is the business cycle. So economic expansion at a time when the Federal Reserve, at least, and I would also say most central banks are cutting. So you've got financial conditions easing 6 to 9 months into the future, but it feels very sluggish because we haven't seen expansion, and expansion usually would have taken place by now. You would think the ISM would be somewhere around 55, 56, 57 by this stage. It's still at 49. It's the longest time in many decades that it's remained below 50 for an extended period of time like it has. But that is sort of the missing piece in the analysis on sort of risk assets. And we all know that liquidity in the business cycle, what are the most sensitive assets to those, to those factors? And it's obviously long duration assets, tech, but also Bitcoin and crypto.
So this is one of the reasons why I really appreciate your work, and why I think it was really timely to bring you on at this moment, is that you bring a very macro perspective to this emerging asset class of digital assets and crypto. And at a time when there's uncertainty in the market and things are pumping, it's always helpful to zoom out and take that larger macro perspective. So thank you for that. I want to bring this back to a focus on Bitcoin, though. Something else I love about your work, you come up with a lot of great metrics to support your analysis. One of them you've been pointing to kind of like, I guess, argue against the bears who say that Bitcoin has topped, is your Bitcoin cycle risk score metric. Walk us through this metric, or maybe just like to get more focused on Bitcoin specifically. Do you think we've seen a top in Bitcoin? Why or why not? And what makes you so confident that we haven't topped yet?
Well, really for the same reasons that I've outlined, but also that if the 125 high from July was really the top, it was extraordinary in a sense that it didn't have the associated euphoria in a lot of the metrics that I look at, which I think are important for identifying tops in Bitcoin. And so if that is it, and if I'm wrong, then what we've got here is a distributive, sort of a distribution top, which is slower and sort of more moderated, because we didn't have the parabolic move at the end of the bull cycle that we've seen in the previous cycles. So the Bitcoin cycle risk score does look to capture those sort of factors which are non-liquidity. Well, there's a liquidity element to it, but really looking at on-chain data and derivatives data. And we didn't see things like funding rates explode to the degree that they did in really early 2024 when the ETFs arrived, or even in Q4 of 2024 after the new administration came in with a pro-crypto stance. So, for me, it doesn't feel like it has the attributes of a major top. And then when you sort of marry that to what's happening with global liquidity and the fact that debt has grown a lot faster than liquidity, and unless they want things to break, that liquidity spigot needs to inflect a lot higher at the same time as the business cycle seems to be turning and central bank policy sort of cutting into that. I think, leads me to the view that actually, we're 2026 at some point, maybe sort of around mid 2026 is going to be the real peak. But definitely, if you look at just the chart, John, and I know that you sort of look at technical, you look at sort of multidisciplinary approach as well. What you can see on like the long-term chart in Bitcoin is this sort of momentum divergence or a momentum breakdown. We're starting to see, the last peak, the RSI actually was lower than the previous peak and the one before that. So there's bearish divergences. So if you were just a technical analyst and you were looking at it purely based on that, you'd be screaming from the rooftops that the top is in, because a bearish divergence on a weekly chart using the RSI in Bitcoin, to my knowledge, it's the first time it's ever happened. If it happens in the S&P and the NASDAQ, usually there's a major sort of pullback around the corner at some point. But that's what I think the sort of multidisciplinary approach is designed to do. It's designed to give you context to signals. And if that's happening when all these other things are starting to turn, I'm not as concerned as I necessarily would be if it had occurred after a parabolic move. Derivatives positioning went all one way, leverage increased, and we started to see, more turnover from long-term holders of the Bitcoin holder base, for example. Then those ingredients together would be very clear, but that's not what I'm saying.
This is really helpful too. I think that this is something that I try to remind myself as well, is that no one indicator is going to tell you the direction of the entire market. And I think it's CoinGlass has a repository of 30 different Bitcoin cycle top indicators that they track, and none of those have fired either. So this is really helpful. Like if you're looking at one thing that, maybe this looks toppy, you still have to put that in the larger context of the market. So that's just really helpful perspective. Thanks for that insight on that. I wanted to save this for the end, but since we've gotten deep into this liquidity conversation, let's just keep going on this track. You all at Real Vision are really now famous for popularizing this idea that crypto is tightly correlated with the liquidity cycle. A lot of people are posting this on X, all different kinds of charts on this that don't really understand the analysis and get it wrong. And they're saying now that Bitcoin has started to deviate from this liquidity. What are people misunderstanding here? Have you seen this on Twitter? Does this frustrate you? Can you clear this up for us? Like, what is the truth of this? Because your work is getting ripped off in a lot of different ways, and it's not always helpful,
Yeah, you'd have to be living under a rock not to have seen that chart. But I can't take credit for the chart that I think you're referring to, which is really the chart that Raul and Julian posted a long time ago, which is global M2 with Bitcoin, and that divergence where M2 sort of basically, forward looking at, there's a lag in the Bitcoin price, but generally with around about a sort of 10 to 12 week sort of lag, Bitcoin generally follows global M2. You're right for pointing out, and thanks for giving the context around it, because one chart on Twitter doesn't tell the whole story. And the work that Julian and Raul do on global liquidity in their product, which is really the GMI product, which is the institutional product, of which Real Vision members get a portion of that within the pro tier. So all of these charts you're referring to are in the pro tier, but the work that they have done is, second to none. I mean, Michael Howell has obviously been doing it for a lot longer and is amazing. And I would put a lot of my understanding around global liquidity is a result of his work, and also Raul and Julian's. But I just want to talk about Raul and Julian for just a second and not take away from all the other great liquidity analysts that are out there, because the one chart that you're talking about has sort of been, passed off, and some of the people aren't attributing it to them, and then they're going and putting their own context on it, and they're not actually looking at the breadth of work that they've done. So what is important in the current market is total global liquidity. We live in a global economy. And so US M2 is just one component, one major component of that. The other thing is that, I guess to answer the question more specifically, is that the TGA, so firstly, I would say when you try to marry correlations exactly within timeframes like that, it's when you start to use it that it will definitely break. That's just Murphy's Law. But that's not what Raoul and Julian were saying. That was just one chart that they put up. Total global liquidity is far more important than just US M2. It includes the global central bank balance sheets. It includes the money supply of other markets. It includes FX reserves. And there's other factors which go into looking at collateral levels in the shadow banking market. Importantly here, the TGA, the US government's checking account, essentially, which sits at the Fed, which is most likely the reason why we've seen that divergence of late. Because in the last couple of months, the US government has been refilling its accounts, been issuing a lot of short-dated bonds or bills. That's been taking liquidity out of the market. That's taken the TGA from around, I think, 200 billion to about 750. So that refilling of their account is liquidity negative. Now that they've reached that level, that liquidity drain is effectively over. And so that could be the reason why Bitcoin has not kept up with, I guess, the global M2 metric. But all of that content and all of that context is over at Real Vision. I would just say that, look, in my analysis is that, I come from a technical analysis and a sort of quantitative systems background. And the relationship between global liquidity and asset prices is exceptional. It's like one of the strongest things that I've ever seen. But that doesn't mean that the R squared or that relationship, that explanatory factor of one on other doesn't wiggle and change over time because markets are totally non-stationary. But should it matter in the end? 100%, because every extra unit of liquidity or currency that goes in the market finds a home. It generally finds it a home in asset prices. And then you start looking at which asset prices are the most sensitive to the increases in liquidity. And of course, you've got tech, crypto, Bitcoin, some more than others. So, an element of that increase in liquidity finds its way into these assets.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
So I think that's really helpful. I will say, in full disclosure, today actually on X, we had a bit of a back and forth because our Milk Road macro account shared this chart that you're talking about without citing Raoul and Julian. So we had to make amends and mea culpa and give them a citation on that.
I appreciate that.
Okay. Yeah, no, absolutely. Look, credit where credit is due. Absolutely. So bringing this back to crypto, Bitcoin has been lagging. What is your prediction, or what are you seeing as the path forward for Bitcoin in Q4? Are you expecting this to catch up with some of the outperformance of the rest of the market? Do you think we see a blow off top? What are you seeing as Bitcoin goes into Q4 here?
Generally, Q4 is seasonally a good period for Bitcoin and crypto. Like seasonality, those seasonality charts are pretty sort of dicey as well in terms of just trying to look at them as sort of some sort of guide. But generally, Q4 and Q1 are strong for crypto in general. It all really depends on the dollar. The dollar's the massive swing factor here because central banks, although they're cutting in terms of interest rates, which is liquidity positive, but really only at the margin, it doesn't make a massive difference to asset prices. It does to the business cycle, which has a knock-on effect for capital expenditure and consumer spending. So generally all very, very positive. But without central banks actually expanding their balance sheets, then really what happens with the dollar is the most important thing right now to track. So I just constantly look at what the DXY is doing. The DXY had one of the largest declines in Q1, Q2, and really into Q3 in decades. And that's the reason why I think even on, the last time I was on the show, John, was one of the main reasons I published like the bullish Trinity report, at the start of April, saying I think risk assets and crypto are going to go up a lot because of that. The speed of that decline was so significant. Now we're seeing the DXY sort of hold around sort of 90, 98, 99. It really mattered. The next leg of that move, whether it's a retest of 101 or a breakdown below, will, I think, be incredibly important for risk assets. My view is that we'll probably test around 100. And so it might be a couple more weeks of chop. But eventually with interest rate cuts and what Trump is trying to do with best interest to try and bring the dollar down, that there is another leg lower. And so at some stage in Q4, maybe in November, we'll start to see crypto start to really catch a bid again. But, there's probably some assets that are worth buying right now with a view to the next sort of 6 months being particularly good.
Gotcha. So you're anticipating, so just to kind of recap this section, global liquidity is still rising. And we've had the Treasury General account refill, where they, like you mentioned, they extracted about $500 billion of liquidity from the market, which dragged liquidity and dragged crypto. Now that's over or about to end. And so the bull run can continue. And you're saying maybe some more chop, but eventually as we get deeper into Q4, you're expecting this to go higher. I think that's something that a lot of people have been wondering about, and I want to get your thoughts on this too, is now that the Fed has started to cut interest rates, we've got one cut in September, we're expecting to get another one in October, some people are saying even another one before the end of the year. How important is that for crypto markets in your mind? Does that have a big impact on digital assets? Is it going to impact Bitcoin, but not the rest of crypto? How big of a deal is this, or is this already priced in?
I think it's important for financial conditions in the business cycle. So cuts will, supercharge the ISM and bring it back above 50 and sort of, I think, continue or accelerate the improvement on that end. But I don't think it's as important for like just asset prices in general. I think asset prices respond to more of the quantitative policies from central banks. And at the moment, even though it's marginal, the Federal Reserve is still tightening its balance sheet. They're still conducting QT. So I don't expect them to change. Like we don't have a federal a Fed chief that's, I think, going to, while he's in charge, retire that policy. But it's coming to an end at some point. So, whether it's with the new Fed chair next year, if you just look at the way central bank balance sheets have always clipped major turning points in crypto, I think that's more important than interest rate cuts. But that's not to say that they're not important, because the business cycle needs interest rate cuts. Interest rates are too high relative to the economic growth. They need to bring that down. They want to bring that down, interest rates down, so that they can unlock equity in people's primary asset, and sort of spur economic growth through the property market. So all of these things are definitely positive for crypto, but it's not the good old days of the 2010s where it was QE2, 3, QE infinity, and everything just responded on a dime to those quantitative measures. But I think those policies get retired, and also there's probably another trick up their sleeve with adjusting, like the government adjusting the SLR, the supplemental leverage ratio for banks, so they can increase liquidity into the market through more lending. So that would be, that would directly flow into M2.
Gotcha. Yeah, it's really helpful insights on that. And I do think that this is something that is really important. What you mentioned, the Fed is continuing their quantitative tightening, even though they are still now starting to cut rates. So there's a lot that you've brought up here that, like I said before, gives a much bigger picture here Really helpful stuff. I want to move now to a recent report you wrote for Real Vision on smart contract platforms, because I think that there was a lot of great alpha in this, and just like I said, a really institutional grade framework to take to the crypto industry. You highlighted at the start, smart contract platforms have processed $57.8 trillion since 2020, and they're compounding at approximately a 78% annually. What is driving this explosive growth in this, and what do investors need to understand about this huge trend? Because this is enormous amounts of liquidity we're talking about here.
Yeah, so I hadn't done this analysis really since 2022, and the data providers are getting a lot better with capturing settlement volumes. And settlement volumes in the crypto context means they are tracking, settlement flows which are related to peer-to-peer transfers of the native token on an L1, transfers of any other tokens related to that L1. So on Ethereum, it's ERC20, and on Binance, it's their token protocol. So it basically assets moving on chain, but also peer-to-peer transfers of stablecoins and DEX volumes. There's also NFTs, but NFT volumes are really sort of negligible at this point. So you put them all together and you come up with like total settlement volume. The problem at the moment with this data is that even though the data providers are sort of are scaling it up, when you look across chains outside of Ethereum and Solana, you don't have all the data for all those different activity cohorts, but you get a pretty good proxy. So it probably undercounts. Well, it definitely undercounts total settlement volumes, but most of the volume is actually quite concentrated in Ethereum and Solana and also Tron, and there the data is a lot more comprehensive. So you've got a pretty good proxy. Now, the biggest drivers are DEX volumes, actually, which are on Ethereum and also on Solana, account for a large portion of fees. So you could argue, hey, it's just speculative activity. It's degens doing degen stuff. The reason why I did this analysis is that I think it's so important for everyone who's investing in crypto or thinking about investing in crypto, is like, where will we be in the future? So the subjectivity that I experienced when I started working as a crypto research analyst at Bloomberg Intelligence, and you get the sort of sniggly remarks that, this kind of settlement volume is not the same as settlement volume on payment platforms like Visa and MasterCard and PayPal and whatnot. Well, really, what was it showing initially? It was showing that the technology can scale, is far more efficient. The velocity of money that moves inside the crypto economy is magnitudes more than the fiat economy. What is the problem with the fiat economy? Velocity has been declining for decades upon decades, despite the Keynesian economics models and theories saying that they could tweak it through government policy and monetary policy. That has not happened, although we've seen a spike since COVID, but generally that trend has been down. Low or declining monetary velocity in any economy is not good. It shows that capital is not moving. It's not moving into productive use cases. It's not spurring activity and entrepreneurship. In fact, I would argue that the main reason, or one of the reasons that velocity is going down, is because that all new money, or most money, is flowing into investments, not into productive uses, not into the real economy. In Australia, the banks won't give you a small business loan. They'd rather lend against your house in a property market that's like, trading on 16 times median earnings. So this is a huge problem. Meanwhile, this parallel system full of degens and, libertarians is showing that they can move immense amount of value, and that value that the crypto economy has moved in the last 5 years is almost as much as Visa, MasterCard, and PayPal, but it's growing at 7 to 8 times that in terms of annual growth rates. So within 2 years, it's going to overtake. What happens when Visa, MasterCard, PayPal, which they're already doing, start moving all of their value flows or the settlement volumes onto blockchains? So you get this exponential explosion again, and then the critics can't really argue that it's just degens anymore, because it's actually them paying for their coffee or paying for their Amazon gift card. So it was just really a way to sort of go back to basics. The analysis I was doing in 2022, I was looking at Bitcoin and Ethereum specifically. Now look at the entire layer ones and go, hey, like these guys are growing at a clip, and now all the payment companies are going to actually integrate with them. And that drives the asset price. That drives the value of the L1 token. The L1 token is the settlement token of the chain. And even with new chains coming on that are stablecoin specific, everything is growing the pie. There's going to be winners and losers, but the pie is growing substantially. And we go from, 80 trillion, in 5 years. We do that in like 1 year and 2 or 3 years time is my expectation.
There's a ton of alpha in what you just shared. I think you answered like half of the questions that I wanted to ask about this. So I want to take this piece by piece and kind of break down this a little bit more. And I want to start with, I think, the way that this drives value to the native tokens of these ecosystems, and explaining that more so investors can understand that, our audience can understand that. Obviously, what you're talking about here is like a movement of the crypto industry, all of these smart contract platforms, Ethereum, Tron, Solana, all the other ones like you've mentioned, move that from just a tool for speculation, but to becoming really important transaction settlement infrastructure. Why does that matter for the native value of these assets, and how, connect that transition back to the token prices and number go up, and to draw that connection for us? So
in the report, there's a lot of statistical analysis, and what I uncovered is maybe slightly counterintuitive. And that is that when you see large spikes in settlement value on chain, usually at the moment, because crypto is a lot of that value that's settling is related to speculative activity, DEX trading, NFTs, that when you see large spikes, it actually correlates with negative forward returns over the next 6 to 9 months, which was interesting. Now, that's a function, I think, of the type of activity that's on chain now. So if I was to speculate going forward, if more settlement volume is of the variety like traditional payment rails, merchant payments, B2C, then that volatility in the settlement volume will decline, but it will supercharge it. And actually what it will do is underwrite the value of the tokens themselves. Every dollar that settles on chain pays a transaction fee. That transaction fee goes to the security of the network, and in some instances, a tokenomics model where it burns, so it supports the token price through that mechanism as well. And so, it's important. Ultimately, at the end of the day, the value of L1 tokens are driven by the utility of their network, the growth in the network, and also how much of the L1 token is being used to collateralize the network. And so if settlement volumes increase, validator returns increase, token burning increases, more capital gets staked, more capital goes to L1 token and used in collateral pools in the DEXs and in the lending, in the DeFi applications. And also, validator returns will also increase as well. So it's a flywheel effect. The problem at the moment is it's extremely cyclical based on speculation, but that should moderate over time.
Gotcha. So you're describing an economy, right? And that's what I think I want our listeners to understand, is that by turning these platforms from just a tool for speculation and more into this like long-lasting settlement layer infrastructure, it moves a lot of lasting, sustainable economic activity into these ecosystems, and these native tokens are at the heart of that, and that can drive an enormous amount of long-term value there. So you talked a lot about the growth and ways that this analysis can help you identify assets that might be primed for outperformance. You pointed to Hyperliquid as the strongest growing settlement platform in the recent past. But I think the other thing is that people have started to figure out that there's trillions of dollars that's being settled, building their own L1s, launching different competitors. And so I thought taking Hyperliquid as an example would be interesting for that. There's some strong competitors like Aster and others that have launched to compete with them on their perps volume. How do you see this impacting hypes future growth. And I guess you could take this really for the broader ecosystem for all these different smart contract platforms. But yeah, how do you see this now? Like all this competition coming in to try to compete for this capital. Where do you see that going as these different competitors fight for market share?
Yeah, like I mean, with blockchains, when you're early in your adoption curve, there is very little moat. So the ability for a competitor to start up and compete with, with a high degree of incentivization to bring activity on chain is a constant threat for these protocols. The question with Hyperliquid is, has it reached some level of escape velocity that even though these competitors who are coming in now, who are basically replicating their model, can actually, in the long term, destroy Hyperliquid's emergent network growth that it's already got? What do I mean by that? So Hyperliquid, in terms of settlement volumes, this is one asset that the data providers haven't really broadened out their settlement volume information on, apart from DEX volumes. So we've only got that to go on at this point. And in all fairness, it's really such a young L1. There's not a lot of other types of activity. But if you want to look at a clue in terms of whether there will be more activity, more diversity of activity on the L1 in 12 months' time, then look at the number of applications that are building on Hyperliquid today versus at the start of the year when they launched. It's sort of, it's gone from essentially one, which they're perps DEX, to around sort of 30 or 40, which is on par with Sui. Sui's been around for a couple of years. It's one of the emergent sort of L1s, not a tier 1 L1, but an emergent L1. And so these are the signs that you sort of look towards in the future for it to be able to, lose market share in the short term as competitors come on, but broaden out its, its revenue, its fee income across different parts of the DeFi stack and sort of sustain itself going forward. So I think the outlook for Hyperliquid is still very strong. There is definitely a degradation in the last month or so in terms of perps volumes, DEX volumes, fees, TVL. But that is kind of, like I wrote about Hyperliquid in April, I think it was. And I said, by October, these are the things you got to worry about. You got to worry about the unlocks, and you got to worry about all the competitors that will no doubt come in, because this, as I said, is like essentially a free and open market. It's open source code. People are going to copy it, and that's going to be the major threat. It's, can they get to a certain level that can sustain themselves over the long term? And I would argue that, it for me, it takes its position in the portfolio, and I'll be holding it unless I start to see the team start to do anything not extraordinary. The unlocks are a real threat. It's whether they really start to, dump a lot on the market, which would destroy confidence. So I can't see them being that would be suicidal for their network right now, given the competition that's out there. So it'll be interesting to watch, but I'm still reasonably confident in Hyperliquid long term. It's trading at a multiple too that, if you look at it like S&P 500 software and tech stocks, that is pretty much the median of like traditional equities. So you're not overpaying for it either. But in everything in crypto, it's not so much the valuation that matters, it's the growth. So if it can't sort of get through this period of plateauing and then start to grow again into next year, then there's an argument to be made that it's lost its momentum.
Yeah, I think that's really a helpful analysis of the situation on Hyperliquid, but I think it applies to so many other things too, because anytime any business, but particularly in crypto, finds product market fit, immediately tons of competitors come to compete with it. And in some ways that's, a bad thing, but in many ways it's a very healthy thing, because that competition forces new improvements. It leads to better outcomes, better user experience, more innovation. But yeah, you saw this with the copycats that came after Bitcoin, the copycats that came after Ethereum, with Uniswap, all down the line. There's always been, anytime anybody finds a business that works, a lot of competition comes in to try to do it better, and the market keeps moving forward. So I think that's a really helpful insight on that. I was really curious when I read this report. Smart contract platforms have been around for many years. What prompted you to decide to write this now? Has this been research that you've just kind of been revisiting every few years? Or is there some particular catalyst that prompted you to write about this particular subject at this point in the market?
So it's really a part of a series of reports that I'm writing that I think will get me to the point where I've got a rounded model for scoring these assets. So I wanted to tackle each of what I thought were the major sort of pillars of value or valuation for these L1s, and look at it in isolation and sort of build up the picture as I go over the next couple of months to get to a point where I think there's the ability to score, rank, and also build systematic portfolios based on the characteristics that I've uncovered in this sort of journey. I would have liked to have done it like a year ago, but so many other things sort of pulled me in directions, whether it was Bitcoin on-chain analysis, whether it was my macro framework. So I've come back to something that I actually started at Bloomberg Intelligence back in 2022 and 2023. And yeah, it's going to be a series. The next one I'm looking at is like how important are collateral levels in the DeFi ecosystem and the role that they play on the L1 token price. So look, I mean, I can't promise that I'm going to uncover the unified theory of crypto asset valuation. It doesn't exist, but hopefully there is a better framework to guide investors through, rather than the, for lack of a better term, X flicking that goes on Twitter, and the narratives and the shilling and all of the content creators out there who are just trying to pump bags. There has to be a more thoughtful, systematic approach to this investment class. And that's entirely what every institutional investor who's now creating a desk or creating a team are training their team to do as well. So it's just a matter of time that it sort of matures into this direction.
Yeah, when you do find the grand unified theory of digital asset valuations, I look forward to citing you when I rip it off on Twitter. I'm really looking forward to that, Jamie. Really helpful insights on this. I think that it's helpful to just hear how you're thinking about this, right? There are so many different things in crypto that are need your attention and analysis, just like every investor. But to always come back to things, to revisit, to update the models, to continue to develop your analysis along with the developing market, I think that's a really helpful perspective too. We're getting close to time here. I want to end this question with what's in your wallet. You are one of the leading digital asset analysts in the world. Now, you mentioned that Hyperliquid stays in your bag for now. What else is in your wallet going into Q4? Where are you most allocated? What do investors need to be paying attention to as we go into the last quarter this year?
So look, I mean, I maintain a really boring portfolio. Bitcoin's the core of my portfolio. If you're looking at some sort of more, risk-taking opportunities that are out there, you would be looking at smart contract platforms. So what I've been doing over the last, really since March, is I've been allocating into smart contract platforms. And the ones that I feel confident in because they have the network growth and the sort of characteristics which I think make them resilient are things like Solana, Sui as a smaller but a more emergent L1, Hyperliquid, Tron, which is sort of on my negative watch at the moment because I'm just trying to see if there's any sort of momentum degradation in terms of its stablecoin volumes from the new chains that are starting up. But if you look at the chart on Tron, it never gets talked about. It is like one of the most unbelievable charts you've ever seen. And so based on that, based on settlement volumes, the fees, the buyback, the tokenomics there, separate Justin Sun, which is hard to do and is definitely a major risk. It is still one of the assets that I think, and has been doing really well, that deserves a position in the portfolio just based on looking at it from market share and growth of the important metrics like settlement volumes and fees. And I'm not sure I mentioned Hyperliquid, but Hyperliquid as well. These are the ones that I've focused on, but I've got a couple of on the watch list for Real Vision Pro community that I'll be sort of updating on in the next couple of weeks because I think there's one more opportunity for the altcoins as the shift happens from Bitcoin into alts, which we didn't really talk about, but started in March, I think was crystallized in July and should continue as the business cycle expands. Business cycle expansion correlates wonderfully well to altcoin outperformance. So yeah, that's where the sort of the risk takings or how the portfolio is shifting.
Yeah, so I really appreciate that answer. I'm not going to take the bait on the Tron question, but I do think it is an unbelievable chart, however you want to interpret the word unbelievable there. But I think what I would tell our audience to take away from this, though, Jamie is right. We are seeing this rotation into alts start to happen. There is more room in the bull run. There is more liquidity coming. This is a great time. Now, you don't have to mirror Jamie or my portfolio by any means, but this is a great time to really revisit your research, revisit your portfolio, your thesis, and just make sure that you're allocated properly going into Q4, because there is still some opportunity here. Jamie, you have something else to add?
Don't use leverage. Don't go over your skis. Position size accordingly. If you're buying a asset that has 4x the volatility of Bitcoin, maybe you should have a smaller position size for that asset in case you don't get it right.
Yeah, and the recent round of liquidations, something that I saw was actually kind of like you were saying, like bullish for alt season, was there was so much leverage that was washed out further down the risk curve from Bitcoin. It was mostly in Ethereum and in altcoins. So people are getting, just like you said, over their skis, over anticipating alt season and taking out leverage where they probably shouldn't be. So thanks for preaching the gospel on that. Jamie, this has been really helpful. I feel much calmer, much more secure, and much more ready for Q4. Where can we send people to find more of you and your work online?
At Twitter, Jamie1Coutts, and over at Real Vision on the Pro platform. Come over and check it out. We've got actually a brand new launch of the entire website, which includes a whole lot of AI integration, dashboards, not just the research and the videos. So come and check it out.
Well, thank you. I just speaking for myself, but also for the rest of the community, we really appreciate the work you're doing. Keep it up, and best of luck to you. Thanks for being on the show today. I hope we can have you back again really soon.
Yeah, likewise. Keep up the good work too, John. Thanks.
Thanks, Jamie. Thanks for being here. And thank you all for joining us. And we will see you all on the next episode of the Milk Road Show. Stay safe, stay bullish, stay educated, and enjoy the bull run.
We're sending Kyle Reidhead, our head of research, to the UK's largest Web3 summit. I'm talking about Zebu Live, happening October 21st and 22nd in London. Want to join? Use our code MILK to get 20% off your tickets. Hit the link in the show notes and say hi to Kyle for us. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.